financial reporting. Now, as a student, before you even understand what is financial statement analysis, first of all, you need to understand what we mean by the term financial reporting. Financial reporting. Ordinarily what is referred to as FR. Now, when talk about financial reporting, we say that this is the process through which now an entity, or basically a company, will be reporting its financial performance, its financial position, and also changes in the financial position at the end of each year. So therefore, in this case, we can say that this is a process. This is the process. The process through which an entity or a company reports its financial performance, its financial position and changes in financial position, changes in financial position. And therefore, when talk about the financial reporting, this is that particular process through which now a company will have now to prepare the financial statement at the end of the year. Because what you need to note is that each and every company, according now to the various provisions of the Companies Act, it has now to prepare financial statement at the end of at the end of the year. So therefore, still we can also be able to say that financial reporting is that process through which an entity or basically a company prepare the financial statement. Now, what you also need to remember here, what you did in CFA Section 1, you looked on the various components of the financial statement prepared by a company or by a business entity. And in this case, therefore, when we talk about now the financial statement, we are talking of number one, what refer as the income statement, and number two, we do have a statement of financial position. This is what was formerly known as the balance sheet. And number three, we do have what refer as the statement of changes, the statement of changes in equity, statement of changes in equity or net asset. Number four, we do have what refer as the statement of cash flows, the statement of cash flows. So therefore, any business entity at the end of the year, it has now to prepare those financial statement. And remember what we have said is that the main objective of preparing this particular financial statement is for a company to be able to communicate various aspects. One, how it performed during that year. Two, its financial position, or basically the asset it owned, the liabilities the company do have or the business do have at the end of the year, and the changes in the financial position of the business. So therefore, that has to be done by any business entity at the end of the year, according now to the provisions of the Companies Act, and also according to what refer as IS number one. Now, on the other hand, when talk about what refer as the financial statement analysis, financial statement analysis, that is what is abbreviated as FSA. Now, we say that this is that particular process through which now a person who is known as a financial statement analyst will be trying to understand the risk and also the profitability associated by a business entity using now this particular financial statement which were prepared at the end of the year plus other information, so that then that information can then be used in terms of making various economic decisions. So therefore, in this case, we have said that a financial statement analysis is the process is the process through which a financial statement analyst will understand the risk and profitability of an entity using various components of financial statements and other information for decision making purpose purpose. So that is the definition of financial statement analysis. But on the other hand, this can also be defined to be that process through which now the person who is known as a financial statement analyst will take now the various components of the financial statement prepared by a company and be able to analyze them or be able to extract some information which then will be used in terms of making various decisions. For instance, if at all maybe we have a potential investor who intend to invest in a company in terms of maybe buying shares in that company, and because he has now to do some due diligence, he has to get more information about the company's performance, the company's financial position, and so on. Maybe he can procure the services of a financial statement analyst who now will be required to analyze the financial statement of a company and be able to give a feedback as to whether it is viable to invest in that particular to invest in that company. That's why in this case then you need to differentiate between financial reporting and the financial statement analysis. Now, whenever now this analysis is to be done, that is the financial statement analysis is to be done, there are those particular steps which are supposed now to be followed by this person we have referred to as a financial statement analyst. Of which in our case we do have 6 steps which are followed in financial statement analyst. One is setting the objective, the objective of the analysis. Now, this particular step here, that is setting the objective of the analysis, or maybe the objectives of the analysis. This whereby the financial statement analyst will actually need to know why he need to do that particular analysis, or basically why he need to analyze the financial statement of a company, plus now the other information which may be accompanying those particular financial statement. Now, once now he set that those particular objectives, number 2, he need to proceed and gather data. Now, in this particular step here, that is step number 2, this whereby the financial statement analyst will actually now be required to gather the necessary data which now will be used in his analysis. Remember here, in our definition, we have said that the financial statement analyst will try to understand the risk and also the profitability of the business using the financial statement and other information. So therefore, the data now which is used in analyzing the financial statement, this will include the financial statements themselves which were prepared, and other data or other information. Now, this other information will include information such as the director's report, that report prepared by the directors at the end of the year. It will also include what refer as the chairman's statement, which also accompany the financial statement. That information may also include what refer as the proxy report or the proxy statement, issues to do with the auditor's report, and so on. And we are going to look on that other information, which now the financial statement analyst now will use whenever now he is to analyze now the financial statement. Now, once now the data has been gathered, stage number 3 is to process is process that data. Step number 3 is process the data. Now, in this case, when talk about processing the data, this whereby the financial statement analyst will now be required to process that data, of which when talk about processing the data, this whereby various tools and also techniques, that is accounting tools and techniques, will be used by the financial statement analyst, such as ratio analysis, the common size analysis. We are going to look more on that later on. We'll use to analyze the financial statement. And once now he process data using those various accounting techniques and also tools, then he will then proceed in step number 4 and analyze and interpret the data. Analyze and interpret the data. So mean that once now maybe the financial statement analyst has analyzed or basically processed that data, like maybe let's assume that he has processed that data in terms of computing various ratios. Now, in this particular step here, that is the analysis, this whereby, for example, he will be required to analyze that information. Maybe he analyze those particular ratios for various years, and once now he analyze those particular ratios for various years, then from there he will be in a position to do what? To interpret that data, or basically to be able to come up with more information regarding the picture which is portrayed by those particular what? Ratios. For example, in that case, maybe he can be able to see that the profitability of the company has been improving, maybe the liquidity position of the company has been improving, and so on. So once now that happens, then he will proceed and report the conclusion and recommendation. Report the conclusion and recommendation. Remember, in the first step, what we have said there, the financial statement analyst will actually need to identify the objective, or basically the objectives of doing his analysis. Now, in this particular step here, because in most of the cases the financial statement analyst will be doing that on behalf of maybe another person, for example, a potential investor, here he will be required now to report to such a person on whose behalf the analysis was done, what is his conclusion, and also he can give a recommendation. For example, if at all maybe the financial statement analyst was maybe requested by a potential investor to analyze maybe a certain company, then in this case then he can be able, or he will be giving his conclusion. For example, in this case, maybe he can report that according now to the analysis which has been done, then the profitability of the company has been impressive, or maybe has been increasing over the last 5 years. And if that is the case, then he can then be able now to proceed and recommend to that particular potential investor that investing in that company would be a viable investment. So therefore, in this case now, the financial statement analyst will be giving his conclusion and also give a recommendation from now what he has managed now to analyze there. Then the last step in financial statement analysis entails update of the analysis. Now, this particular step here basically will come after the financial statement analyst maybe get more information, because whenever maybe the analysis was done here, the financial statement analysis did not manage to gather all the data which then was supposed to be used in financial statement analysis. So if at all now he get more information, then he will be required to update his analysis and still be able now to communicate that to the person on whose behalf the analysis was actually done. So therefore, what you need to note is that whenever now the financial statement analysis is to be done, then we do have those 6 basic steps which are followed. That is setting the objectives, gathering the data which will be used in the analysis, processing that data, analyzing and interpreting it, reporting the conclusion, and also giving the recommendation, and finally is updating that analysis as the financial statement analyst get more more information. Then from there, I want us to look on what are the importances. What are the importances of financial statement analysis, financial statement analysis. Now, in this case, once now the financial statement and other information has been analyzed, that information then which will be availed, it will be of importance to various users who include potential investors, who include the management, who include the shareholders of the company, and so on. And therefore, the importance of that information which is availed by the financial statement analyst will include, number one, indicating the trade, of a business, Now, in this case, when we talk about the trade, we are talking of maybe how the company has been performing for a number of years, or basically over a period of time. That means that once the financial statement analyst, for example, has computed various profitability ratios, then the management of the company, or maybe the shareholders of the company, can be able to have a picture of how the company has been performing for the last 5 years. And that's why you have said that one of the importance of the financial statement analyst is that it basically help the various users of that information to be able to indicate what if is the trend in the performance of the business. Two is that this particular information provided by financial statement analyst also may be used in terms of assessing what referred as the liquidity, the liquidity of the business, the liquidity of a business. Now, in this case, when we talk about what referred as the liquidity of a business, or maybe the liquidity of an entity, we are talking of the ability of a business to be able to pay what referred as the short-term debts whenever they fall due. And therefore, once now the financial statement analysis has been done, then the shareholders, the management of the company, can be able to know whether the business will be in a position to pay its debts whenever they fall due. So therefore, the other importance is that it helps in assessing what referred as the liquidity position of the business. Number 3 is that this information also help in analyzing, or basically assessing what referred as the financial performance and position of a company. So that means that once now the financial statement analyst has now processed the financial statement, maybe of a given number of years, plus now the other information, then the various users who include now the shareholders of the company, who include the management of the company, can be able now to assess what we refer to as a financial performance of a business, and also the financial position. And other than assessing that financial performance and also financial position, those users can also be able to do what we refer as a comparison, can be able to do a comparison of the financial performance and financial position of the company with the other companies in the same what industry. So therefore, we do have that as the other importance of financial statement analysis. Now, the other importance of the financial statement analysis, now that is number 4. Number 4 is that it helps the various parties to assess the overall financial strength of a business. Now, in this particular case here, the information which is provided by financial statement analysts help the various users in terms of assessing what is the overall financial strength of the entity, because in this particular case here, the users can actually be able to compare, for example, what are the assets of the company, what are the liabilities, and then from that, then they can be able to say whether the company is financially healthy or not. Now, the other importance of that particular information, or basically that particular analysis, is assessing what referred as the solvency of an entity. Now, in this case, when we talk about what referred as the solvency of an entity, this is whether the business is bankrupt or not. And therefore, once now the financial statement analysis has been done, then, for example, the shareholders of the company, the various interested parties like the readers and so on, they can be able to tell whether the company is technically insolvent or not. Of which, in this particular case, when talk about company being insolvent, this whereby the liabilities of a business are more than its asset, because most of the students tend to confuse what referred as the liquidity of a business and what the solvency. Remember here, we have said that when talk about now the liquidity, basically you have said that is the ability of the business and to be able to pay its debt or not whenever they fall due. But on the other hand, when talk about solvency here, this is the measure of the equality of asset and liabilities. And therefore, in this case, you have said that a company shall be deemed now to be insolvent, for instance, if now the liabilities of that business are more than the asset. So therefore, in this case, we do have those as actually some of the various importances of what is referred as the financial statement analysis. And that's why maybe the management of the company, the various interested parties may procure, for example, the services of a financial statement analyst to be able to do the analysis of the financial statement, so that now they can be able to know the trend of the business, assess its liquidity, assess its financial performance and position, and do a comparison, assess what is the overall financial strength of an entity, and also assess what is referred to the solvency.